According to figures from the Federal Economy Department, just over 905,000 Belgians own 2 or more properties as of January 2025. And that number is growing fast. In 2020, just over 800,000 Belgians own multiple properties. That is more than 100,000 additional multiple property owners in just 5 years. In this video, I am going to give you the 7 things you need to know before buying your second property here in Belgium. And make sure you stay until the last point because it is the one that a lot of investors completely forget to check and it can cost you a lot of money. Let's get into it. So the first thing you need to know when buying a second property in Belgium is the registration tax and how different it is compared to your first home. When you buy your first home in Flanders, you pay 2% registration tax. In Wallonia, that is 3%. But when you buy a second property, whether for investment or vacation, that goes up to 12% in Flanders and 12.5% in Brussels and Wallonia. That is a big difference. Now, the good news, there are ways to get a reduction. If you rent your property through a social rental agency, what is called an SVK in Flanders, you pay a reduced rate of 7% instead of 12%. But there are conditions, of course. You hand over the management of the property to the SVK. They found the tenants and you commit to keeping that arrangement for 9 years. There is also a reduction available if you rent your property to a nursing home, so to an organization that houses elderly people or people with disabilities. So the second thing you need to know is how much money you need to bring yourself. So it's about down payment because the bank will not lend you the same amount as they did for your first home. When you bought your first property, the bank was willing to lend you 90 or even 100% of the purchase price. With a second property, the bank is not willing to take that same risk. You will need to bring typically between 20 and 30% of the purchase price from your own pocket. So if you are buying a property of 300,000 euro, that means you need between 60 to 90,000 euro of your own money before you even think about registration tax and notary fees. So before you start visiting properties, make sure you know exactly how much you can borrow, how much you need to have saved, because the numbers are very different from your first purchase. So the third thing to know is about rental income. And this is actually good news for now. If you are buying a second property in Belgium with the aim of generating rental income, you are not taxed on the actual rent you receive. You are taxed on what is called the cadastral income. So what is the cadastral income? Every property in Belgium has been assigned a fixed, theoretically value by the government. It represents the average normal net income that the property would provide its owner in a year based on a property value from 1975. It is then indexed every year to account for inflation, but in most cases it remains lower than what you actually receive in rent. For example, let's say you receive 12,000 euro in rental income per year. You do not declare the actual rent. Your tax return refers solely to the cadastral income. The number could be 800 or 900 euros, a fraction of what you actually earn. That is a very big difference, and it is why Belgium is still relatively tax efficient for private landlords right now. Now, this brings us directly to the next point, and this one is crucial because who you rent to completely change how much tax you pay. In point 3, I explained that you are taxed on the cadastral income and not on your actual rental income. But that only applies in one specific situation: if you rent to a private individual for residential use. So that is the traditional way of renting a family or a person using your property as their home. The moment that changed, the rules changed completely. If you rent to a company or for professional use, you are taxed on the actual net rent you receive, not the cadastral income. The taxable income becomes the total rent you receive minus a flat rate cost deduction of 40%. So you are effectively taxed on 60% of your gross rental income. That is more than what you would pay under the cadastral income system. So let me give you an example. If you own a property with a cadastral income of €900 and you rent it privately, you might pay around 1,300 in tax at the highest bracket. But if you rent the same property to a company for €900 per month, that becomes 3,200 in tax at the highest bracket. That is more than double. And here's something a lot of landlords do not know. If your tenant is self-employed and works from home and they deduct part of the rent as a business expense, you as the landlord automatically fall into the professional rental tax category, even if you did not intend that. So always make sure your rental contract clearly states how the property can be used. So the lesson here is simple. Know who your tenant is before you sign, because it's not just about finding someone who pays on time. It directly affects your tax bill every single year. So the next thing you need to know is about 2 tax deductions that used to exist for landlords in Belgium and that are now gone. If you own a second property and you have mortgage on it, every month you are paying 2 things to the bank. You are paying back the capital, the actual loan amount, and you are paying interest on top of that. For a long time, Belgian landlords could deduct both of these from their personal income tax. So when you filed your tax return at the end of the year, you could get some of that money back. That was a significant advantage that made owning a second property much more profitable. But those benefits have now been abolished. Since 2025, you can no longer deduct the capital repayment, and since 2026, the mortgage interest deduction has also been removed for both new and existing mortgages. Of course, this is going to directly affect the profitability of your investment. Your gross rental income might look attractive on paper, but once you remove these deductions from the equation, your net return is lower than it used to be. That said, Belgium is still overall a country that is favorable when it comes to earning property as an investment. The cadastral income system we talked about earlier is still in place for private rental. Property values remain stable and the long-term fundamentals are still solid. So the next thing you need to think about is the ongoing costs, because buying the property is just the beginning. After that, the costs keep coming every single year. The first one is the property tax. This is a tax you pay every year, calculated based on the cadastral income of your property. But what a lot of people do not calculate properly is the maintenance costs. Things break, a boiler needs replacing, a roof needs repairing, a bathroom needs renovation. This does not happen every year, but over time it adds up and it can really eat into your returns, especially if you bought an older property. Then there is the management fee. If you decide to give your property to a real estate agency or a property management company to rent it out on your behalf, you pay them a monthly fee for that service. That is a cost that comes off your rental income every single month. And one that a lot of people completely forget is vacancy. If your property is empty for 1 month, 2 months, or 3 months between tenants, you are still paying the mortgage yourself, because there's no rental income coming in, but all the costs are still there. The mortgage, the insurance, the property tax, everything continues. So owning a second property is not just about buying and then sitting back. There is a real cost to maintain it, managing it, and also keeping it occupied. You need to put all these numbers together before you decide if the investment actually makes sense for you. The last point is something that a lot of investors do not think about, and if you do not plan it, it can cost you a lot of money. So what happens when you want to sell your second property here in Belgium? This is something you need to think about before you buy, not after, because if you sell your second property within 5 years of buying it, you may have to pay a capital gains tax of 16.5%. That is a significant chunk of your profits going straight to the government. And why does this apply to your second property and not your main home? Because it's not the property you live in. The government sees it as an investment. So if you buy and sell within 5 years, they will tax the profit you made. After 5 years, you are generally free from that capital gains tax, but within those 5 years, the government considers it as buying and selling for profit, and they will tax you accordingly. This is something a lot of people find out too late after they've already sold, and then they receive a big tax bill they were not expecting. So plan your exit before you enter. Know how long you intend to hold the property and make sure your timeline works in your favor. Thank you so much for watching until the end. If you enjoyed this video, give it a like and don't forget to subscribe and share. And if you like this video, you might also like the one I've linked above about understanding the Belgium state pension so that you can save enough and not depend only on the government when you retire. See you in the next one.